So this is a class for corporate reporting and financial reporting. We combine the two classes at this stage because we are still treating standard, that is IFRS, International Financial Reporting Standards, that are applicable to the two classes. That's what we are treating presently. So if you can see the screen, you can see my screen from your hand. Please use the chat box and say yes. I need you to get familiar with the interface. There's an interface for chatting where you can always draw my attention. Since I've muted your mics and I can't hear you, but if you use the chat box, you say whatever you want to say there. I always can see the screen now. That's the chat box. You see it also on your own at your own end. Just use the chat box, and then I'll be able to know exactly what you are saying. Please, have you seen the chat box? Just play around it on your screen. I want to be certain that you can see the screen, that everything I'm showing you on the screen. So I need you to just type yes in the chat box, just to convince me that you are seeing it. Just look around your screen, you'll see the chat box. I know you can hear me, but I can't hear you. I deliberately muted your mic, so I cannot hear you, but you can hear me. Mr. Sukom, you are raising up your hand. I need you to use the chat box to say whatever you want to say. Just use the chat box to say whatever you want to say. Just go to the chat box. Juliet, have you seen the chat box? That's the first interface before the video interface. The chat box is the first interface before the video interface. Just use the chat box to say whatever you want to say. I want you to get this before we move on, because that will be the only interface for me to have conversation with you as the class goes on. Okay, let me unmute your mic so I can hear you. Maybe I need to do some explanation. Unmute your mic and speak if you have any challenge.
We can't find the chat box because it's not there. It's not the right hand or as well.
Just maybe you can click, like you go back. You are supposed to have two interfaces. One is for chatting, the other one is video, where you'll be seeing everything from my end there. Okay, I think somebody has come in. Mr. David, good morning.
Good morning, sir.
Good morning. How are you doing? You're welcome.
Yeah, I'm fine.
We have two new persons. I'm trying to let them know, familiar with the interface of the screen. Okay, I need you to use the chat box, Mr. David, to confirm if you can see my screen.
Yes, I can see it.
I want you to just type yes on the chat in the chat box. Maybe it will help them to see the interface where they need to type. Okay, can you see this message from Mr. David? Can you see that yes that he typed? Okay, another person is here. We have, I think one other person just joined us. Juliet, can you see? Okay, Juliet is also typing now. Okay, so also coming typing. That's interesting. So that's what I wanted to achieve. So it is really, so now I'll go back to mute your mic. That chat box is going to be the interface for all our conversation. You have anything to say, just type it there. I check the chat box from time to time as the lecture goes on. So you can then, I'll be able to know exactly who has something to say and who wants to say anything. So now this is the interface for our lecture notes. Quickly, I want to revise with us what we did in the last class before we start today's class. So, Okay, I think one other person just came in. That's Dorothy. You're welcome.
Yeah, good
Let
morning,
me
sir.
see. Yes. I will mute your mic now because the class already started. Okay, you're welcome. So, in the last class, we started talking about because about 3 weeks ago, 3 classes ago, we started treating IAS 16, talking about property, plant, and equipment. So we've done three classes on that. So we concluded the class in the last class on that standard because it seems to be the widest standard. IAS 16 seems to be the widest standard. So he talks about the recognition of PPE. That's where we started in the last class. So we talked about what to do with the gain or loss on disposal of a non-current asset, how you account for the disposal of property, plant, and equipment, the disposal of property, plant, and equipment if it is part exchange of an old one. So the videos of all these classes are in this classroom. Of course, you will require data to watch it the first time, but after that first time, you will not need to use your data to watch it again. You can watch it over and over again, and it's as good as if we started the class together with you. So we did the table for how you calculate the gain or loss on disposal of a non-current asset. And then we moved on to talk about, we treated an example on gain or loss on disposal. We went on to talk about how you account for the disposal, and then we treated this. I think I gave this as an assignment, yes. Then we moved on to when you have multiple assets, you bought some, you disposed some. Then we treated borrowing cost, IAS 23, borrowing cost, and how that standard says we should treat borrowing cost in the financial statement. We also treat, so all of these are the information relating to the previous class. Relates to the previous class. So these are the examples. So the example we treated in the class the last time. And the period when you start commencing the capitalization of borrowing cost and when you have to suspend it and when there is cessation of capitalization. So this morning, we are starting on IAS 20. IAS 20, accounting for government grants and disclosure of government assistance. Accounting for government grants and disclosure of government assistance. Governments of every country support businesses because the government generates their revenue majorly from the businesses in the country because of the taxes those businesses pay in the form of VAT and CIT and every other taxes. So they give assistance to businesses. So when those assistance come to businesses, we try to look at how businesses should account for those assistance when government gives them assistance. So that's what this standard is all about. I've seen you, Mrs. Ogunleye, you are welcome. So first we define what government assistance is. Government assistance is action by government designed to provide an economic benefit specific to an entity or range of entities qualifying under certain criteria. Yes, criteria means the conditions upon which those assistance are given. When government there was, I think 2 years ago or so, there was this tax relief given to Dangote group of company because he constructed a particular road that leads to his business. That's a form of a waiver of certain expenses for a company is an assistance. So that's the definition of government assistance. And next we talk about government grants. Government grants. Government grants are assistance by government in the form of transfers of resources to an entity in return for past or future compliance with certain conditions relating to the operating activities of the entity. So government grants is a form of government assistance. Government grant is a form of government assistance, transfer of resources. Government grant is a form of government assistance. So we move on to talk about the things that are not involved in the government assistance. We say they exclude those forms of government assistance which cannot reasonably have a value placed upon them, and transactions with government which cannot be distinguished from the normal trading transaction of the entity. We are saying this standard only looks at grants that actually has to do with some specific things that can be measured. Any general grants that is given to the general public or the particular industry is not this kind of support from government we are talking about under this standard. Before you can talk about accounting for an assistance from government, that assistance will come specifically to your company on the condition that you have met certain on the criteria that has been set by the government that you must meet. So this grant we are talking about how to account for is specific to the entity that needs to account for that grant. So we talk about forms of government grants. Forms of government grants. Government grants may take a variety of forms, including receipt of cash. Yes, they can give money to the company. 2, a reduction in a liability. They can waive tax, which is a liability to the company, and say, okay, don't pay us tax. Where you have tax holidays, you have tax relief, things like that. They can give, so the benefit of a low interest rate loan, that's also an assistance from government. It's government grant. That is, they give you loan and you're not supposed to pay as much interest as you would have paid ordinarily if it were not for the assistance. Then the last one, a forgivable loan from government, a forgivable loan. And we try to define what forgivable is. Forgivable loans are loans which the lender undertakes to waive repayment of under certain prescribed conditions. That is, you are owing me this money, but if these conditions are met by you, let the money go. So these are forms of assistance that governments of nations give to businesses, and the standard we are looking at this morning, which is IS 20, explains how an entity should account for such grants. So we'll talk about accounting treatment of government grants. Accounting treatment of government grants. How do we treat it in the financial statement, which is the core of this standard and what we want to achieve today. A grant must not be recognized until there is reasonable assurance that 1, the entity will comply with any conditions attaching to the grant. So if government says, if you can do this, we will give you this grant, and you do not have an assurance as a company that you are going to fulfill the obligation that will make you get entitled to that grant, then you don't need to recognize it as a grant, because from the outset, you know it's not a grant. Because also we'll be seeing in the standard as we will treat this morning, how that grant can be revoked, and you can be granted some things, and then you have to pay it back. You have to give the money back to government, or a loan that has been forgiven, you will have to pay it back when you don't meet those conditions. So when the company knows that they are not going to comply with whatever criteria government give, they should not recognize grant. Then 2, the grant will be received. That is, a grant must not be recognized until there is a reasonable assurance that you will receive the grant. So first condition is, if you know you're not going to comply with the conditions that will come with the grant, don't recognize it in the financial statement. 2, if you are not certain that the grant will be received, don't recognize it. So once these recognition criteria are met, the grant should be recognized in profit or loss over the periods necessary to match them with their related costs. So say IAS 20 defines the following two types of government grants based on the purpose for which the grant is given. So we have grants related to assets. That is, they say, okay, if you can buy this, okay, we will support you on this asset. That is, you are buying an asset, and I give you some money in respect of that asset. Two, it can be grants related to income. So we're looking at the definition of each of them. Grants related to assets. These are government grants whose primary condition is that an entity qualifying for them should purchase, construct, or otherwise acquire long-term assets. So the grant is saying that the government can say you can purchase, you can construct, or acquire it in any way. That's the grant related to assets. Subsidiary conditions may also be attached, restricting the type or locations of the assets or the periods during which they are to be acquired or held. So, we have talked about conditions earlier, that grants are not just given as a Father Christmas will give gifts to businesses. There are certain conditions that come with the grants. So we talk about grants related to income, which is the second type of grant, second classification of grants. These are government grants. Sorry, I'm trying to correct the error today. These are government grants other than those related to assets. If it is not related to asset, then it is related to income. That's why they group it into those two categories. If the grant is not a grant that is related to an asset, that they are not told to buy this plant, buy this machinery, buy this, construct this plant, things like that. If it is not like that, then it might be that it's related income, because there are only two categories of government grants. So in most cases, the periods over which the costs or expenses related to a government grant are recognized are readily ascertainable. You know the period for which to recognize the grant. If it is related to income, for instance, you know that, okay, this grant will be recognized over the period of this income. We'll be treating an example shortly. You'll see exactly what we are talking about. For instance, they say, okay, if you can go give training, free training to the youths for 2 years, then you're entitled to this 2 million naira. So you know that you are going to recognize the grant over the 2-year period of the training. If the grant is related to an asset and you are to you qualify to receive the grant, then the lifespan of that grant is the equivalent of the lifespan of the asset, the useful life of that asset. So grants in recognition of specific expenses are recognized in profit or loss, for the period, in the same period as relevant expenses. And talk about grants related to depreciable assets are usually recognized in profit or loss. Sorry, let me try to avoid this little interruption coming from this end. Okay. Sorry. Okay. So we don't see those interruptions. Grants related to depreciable assets are usually recognized in profit or loss over the period and in the proportions in which depreciation expense on those assets are recognized. That is, you recognize those grants in proportion to the way you recognize the depreciation. Know how you allocate the grants to each year. Both types of grant must be reported on a systematic basis through the statement of profit or loss. So now we're looking at grants related to income first. That's the first one we want to pick. Grants related to income. Grants related to income. So for grants related to income, IAS 20 states that an income approach should be used and the grant should be taken to income over the periods necessary to match the grant with the cost that the grant is intended to compensate. So IS-20 allows two methods of doing this. There are two methods of measuring this grant. The first method include the grant for the period as other income for inclusion in profit or loss for the period. So you treat the grant as if it's an income that comes on its own. We treat the grant as if it's an income that comes on its own for the period. And so the expenses will also be recognized. The expenses will also be recognized over that period. Sorry, 1 minute. I'm trying to respond to someone that wants to come to class and has not done the needful. I'm trying to put that in perspective this morning. That's why sometimes we're talking to people when before class begins, they will not communicate. It is during class they will now be coming in to interrupt the class somehow. Now, method 2, deduct the grant from for the period from the related expense. So we are going to have our first example. We're going to have our first example this morning. This is on grants related to income. Grants related to income, how we are supposed to treat it. That's what this example is all about. They said a company receives a cash grant of 30,000 on 31st December year 0. The grant is towards the cost of training young apprentices. Young apprentices, and the training program is expected to last for 18 months from January year 1. The program is supposed to last for 18 months, and they want to give them grants of 30,000 naira. They will give it to them in year 0. So when we say year 0, of course, year 0 is a features year. For instance, a grant would take effect from 1st January 2023 up to June 2024, and you receive the grants in December 31st or December 2022. So 2022 is what we are considering as year 0 now. That is the year when the grant has not started effecting. So, and the grant is to last you for 18 months, 1.5 years. That is from the period of 1st January 2023 to January 2023 to June 2024. So actual cost of the training were 50,000 naira in year 1 and 25,000 naira in year 2. The requirement, therefore, is to account for this grant. How do we account for this grant? So let me also share. I'll take you to seeing the screen now so that you can see the worksheets that we use in this class. For those just coming in, we use worksheets to do our computation so that it can be seamless. And we see, since it's an accounting course we are studying, we use worksheets. So please, if you can see the Excel sheet, just type yes in the chat box, please, so that we can move. Let me know if you can see the Excel sheet, everybody. Just go to the taskbar, to the chat box, and type yes. So let me know that you can see the Excel sheet. Just type yes in the chat box, please, if you can see this Excel sheet. Okay, Julius says yes. Okay, I think almost everybody can see it. That's very good. So now, the question we are treating says a company receives a grant of 30,000 naira. Now, when this grant was received, the training program had not commenced. The training would start from January the following year. Therefore, this whole amount of money will be recognized as a liability in the financial statement of year 0. 31st December year 0 seems, just use your imagination, year 0, let's say 31st December year 2022, 31st December 2022. and the training will start from January 2023 and go on to June 2024. So you are preparing, you have received the money in December 2022, and you need to account for it in that December 2022. So the first thing to do as soon as the money comes, the double entry, okay, example 1, as usual, first we put it there, example 1, that's the first example we are treating this money. Example 1. Example 1. So what we are doing is to be able to, so that when you visit the class again, you know exactly what we treated under each example. Example 1 is what we are treating now, and the thing we are studying under example 1 is grant related to income. Grant related to income. How to account for grant related to income when it comes in. How to account for grant related to income. The exercise to do to you. How to account for grant related to income. So the first thing, like I said, is that we are going to recognize this 30,000 naira as a liability. So liability relating to income is always referred to as deferred income. Deferred income, because the income is not earned yet. It's an income, but it will start becoming an income from January the following year, and it has come in December. So the income is not earned. So the first, so let me put it here, grant related to income is what we are treating. Grant related to income. Grant related to income. That's the example we are treating. So the first thing I want to do for us is to do the double entry for the transaction, the double entry. So I'll first do the double entry here, the double entry for the transaction, that is upon initial recognition of that grant, when you are recognizing the grant for the first time. So we have here debit and we have here credit. So let me put the naira sign just for the purpose of clarity. Now what we are doing is, the first thing to do once the money comes in as grant is to debit bank, or you call it cash, depending on how you treat the company, and credit deferred income. Deferred income. And so the amount is 30,000 naira. 30,000 naira. 30,000. That is what the company has received as a grant. So, and the description for it, don't forget, the description for it when it happens like that is what? Being the recognition of the grant received from government. Being the recognition of the grant received from government. We are still going to be doing what we call the financial statement extract for this transaction. We are still going to be doing the financial statement extract for this transaction. That is the first journal that we are to pass in respect of this transaction. And this will happen as at when? As at 31st December year 0. Maybe I should put the year there too so that we can see. 31st December year 0. 31st December year 0. 31 December year 0. That's the first journal that will be passed that year. Then we go to the following year when the real activity has actually done. As at 31st December year 1, 31st December year 1, we are going to be recognizing this income of a grant. But at what rate, at what amount? Don't forget, 31st December, 31 December year 1. We are going to be recognizing this grant as well. But at what amount? the training is supposed to last. The training is supposed to last for 1.5 years. So if the training is supposed to last for 18 months, let me just put it there, 18 months. 18 months. That's when the training is supposed to last. 31st December year 1 is also what? It's just 12 months out of 18 months. So the recognition would be that the 30,000 multiplied by 12 divided by 18. That's the amount we are going to be recognizing. 30,000 multiplied by 12 divided by 18. So, and the transactions will be that we are recognizing this as an inflow this time. We are recognizing this as an income that is actually earned in respect of that transaction. The double entry is we are going to be debiting the expense of that, because that amount is going to be reducing the expenses that we incur. Don't forget that the expenses is different from the income. This is the income we receive from government, and this is the expense we are going to be receiving from, we are going to be recognizing for the training as a whole. So the 20,000, which was, this will be how much now? Let me see, equals 30,000 times 12 divided by 18. That's 20,000 naira, is what we recognize during the period as the income over this transaction. And so we are going to be debiting our deferred income, and then crediting our revenue. And the amount is going to be what? The 20,000 naira that we are going to recognize during the period, 20,000 naira. When we debit deferred income, what happens is that we reduce the amount of liability we recognized previously. Don't worry, by the time we now put everything in the financial statement, you'll be seeing what it looks like. As at 31st December, so this was being the revenue, or being the income recognized in year 1. That's the description to that journal. Being the income recognized in year 1. That's it. That's what we are going to be recognizing in year 1. In year 2, which is the terminal year for the contract, year 2, as per December year 2, the journal will now be that we shall be recognizing the remaining part of the transaction, the amount. So, and what is going to be that amount? The difference between this and 30,000 is just 10,000, and because it's for what? It's just for 6 months. It's going to be for 6 months. So that one will be 30,000. Equals 30,000 times 6 divided by 18. That's 10,000 naira. That's the amount that remains. We recognize in the year 2, which is the terminal year. And what we do again, we debit deferred income with 10,000 naira and credit revenue with 10,000 naira. So that is how to recognize that over that period. Now we will be preparing what we call the financial statement extract in respect of this transaction now. The financial statement extract, we'll be doing that. But before that, we need to do the other part of the transaction. So this one also being the recognition, the income recognized in year 2. So the description here will be being the income recognized in year 2. Year 2 now. Being the income recognized in year 2. That's double entry relating to this transaction for the period that we are going to the lifespan of that transaction. However, this is the income we receive from government in form of a grant for this project. But that's not the equivalent of the expenses we actually incur. The company, the actual cost of training were 50,000 naira in year 1 and 25,000 naira in year 2. So in year 1, there's going to be another journal here relating to the expense we actually incurred. So I'll put that here. So let me just talk about the actual expenses, journal for actual expenses, actual expenses. So the journal that we're going to be passing relating to the actual expenses, that in year 1, at 1st December year 1, we are going to be debiting expense. We are going to be debiting expense, which is a training expense. Training expense. We debit with it how much in year 1 according to the instruction. It was 50,000 naira they incurred as expense. So 50,000. We can credit bank, assume that they have paid. If it's not paid, let me say slash payable. If it is not paid yet, bank slash payable, that will be 50,000 naira as well. 50,000 naira. So being the expense on training. Being the actual expense on training. Being the actual expense on training. Being the actual expense on training. That's the description for that journal. In year 1 and in year 2, 31st December year 2, we are going to be having the same journal passed, but at a different amount, the expense and the transaction. So this time it was how much in year 2? In year 2, it was 25,000 naira. So 25,000. That's the journal for year 2. So now we will do what we call the financial statement extract, that will show exactly how this will appear in the financial statement. Journal is to give us a background of the account to debit, they want to credit over the period. The account to debit, they want to credit over the period. Now that we have seen the journals, let's do the financial statement. This is just a rough work. It's just for us to calculate the amount we are going to be putting here, which you can also do in your notes for you to have understanding of what we have actually done. So let me say we want to do now financial statement extract. So we are going to have the statement of profit or loss first, statement of profit or loss, extract. So statement of profit or loss, extract. Now, there are two methods for measuring grants related to income. In the notes, the first method is what? Include the grant for the period as other income for inclusion on profit or loss for the period. So method 1 is what we want to do now. Method 1. So let me put it here. Method 1. How we are supposed to treat it under method 1. We want to include the income as other income in the financial statement. So under other income, so method 1 for year, this is for what? Extract for year 1. Extract for year 1. Don't forget, nothing comes to the profit or loss account in year 0. If you look at the journals we pass, we are not recognizing anything in the profit or loss. Deferred income is a liability, it's a balance sheet line. When we get to balance sheet for year 0, we will do that now. And for as a balance sheet, And bank is also a balance sheet line item. So that's why in the profit or loss account, okay, let me quickly have a table of these the years, so that we don't need to be creating different accounts. So let me say this is year 0, then the next one, let it be year 1, and then year 2. So let me just have it that way, so that we have a seamless. So other income under year 1, other income. In year 0, nothing will be there, no recognition for that transaction in year 0. In year 1, what we did was to credit other income, which is revenue. Other income with 20,000. In year 2, what we did was to credit other income with 10,000 naira. So that's it. Other income in year 2. This is how the financial statement will look like relating to the grant. Year 0, we have nothing to recognize. Year 1, we recognize 20,000 as other income. And year 2, we recognize 10,000. So now we are talking about the expense, that is training expense. Training expense in the 3 years. Year 0, of course, there was no expense incurred. Year 1, the company incurred how much? 50,000. That's the journal we passed there. Debit training expense, 50,000. And in year 2, the company incurred an expense of how much? When we credit the expense, is 25,000. I should have put this 25,000. Of course, this expense will be in jackets. I should have done that. Let me just put a minus sign there so that it will appear the way it will appear. Expenses are debit transactions, debit line items under statement of profit or loss. And so this is how it will appear under method 1. This is how you are going to have it stated under method 1. You are not netting it off. The two of them will appear on the face of financial statement like this. So other income, we can put in front of it grant, so that we know grant. Other income, we put in front of it grant. So, and training expense, this is it. In year 1, under method 1, let's see the balance sheet of method 1. What the balance sheet of method 1 will look like. What the balance sheet of method 1 will look like. Sorry. What the balance sheet of method 1 will look like. So we have this as our what? Statement of profit or loss extract. So let's have statement of financial position extract. 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 So we are going to be having the 3 years as well, as we have it here. The 3 years. The 3 years will be here. The 3 years will be there. 3 years will be here over the period of the transaction. So, sorry, trying to make it sooner. So, under liability, that is non-current liability and current liability is where we are going to be treating this transaction. So let me first have the current liability first. Current liabilities. Current liabilities. So we have deferred income. And as at year 0, deferred income current liability will be the amount of the deferred income recognized for 1 year. Don't forget, current liabilities are liabilities with a lifespan of 1 year. And for non-current liability, so here we have year 0, we have it like that. Non-current liability, non-current liabilities. Under non-current liabilities, we still have what we call deferred income. This is a financial statement over the life of the account. For that year zero, non-current liabilities are how much? 10,000 naira. For that year zero, don't forget what we have done. 10,000 naira. For me? Yeah. Okay, let me just pick it from there. 10,000 naira. So that the amount of deferred income recognized in year zero will all amount to the 30,000 naira, which was what we actually did when we credited it upon initial recognition. 30,000 naira. You can see the first journal we passed in year zero, debit bank and credit deferred income. So we are showing what the face of the financial statement will look like in each year. So in year one, the current liability will be the 10,000 naira that is dischargeable in 1 year time, and the non-current liability will be 0 in year one. That is it. So that as at the end of year one, the closing balance on deferred income will be the 10,000 naira that we have recognized when we said what? We are what? The deferred income, it is in year two. So at the end of year one, this is what the financial statement will look like, balance sheet. And then in year two, 0 current liability, 0 non-current liability. Shikena. That's it. That's how the financial statement will look like over the life of these assets, over the life of these what is called grants. I hope you have seen it. This is method one, how they said we should treat it. This is what the financial statement will look like. Statement of financial position and statement of profit or loss. Do you have a question relating to this? Please use the chat box. Please, sir, hope to see the video later. Okay, Dorothy has said she will not be available throughout the class. That's fine. Sorry, everybody, this method one that I just worked on, do you have a question on it? The method one says, just check in the note, method one, include the grant for the period as other income for inclusion on profit or loss for the period. That's how the method one says we should do. And that's exactly the way we did it. Under other income, grants, year zero, we are not going to recognize it. So we have deferred income for year one, current liability, 20,000, non-current liability, 10,000. Then the year two, only current liability, year one, only current liability of 1,000 is recognized. At the end of the period, there is no current liability again. So method two is just a little bit different. We are not going to be passing any journal. The journal is the same, just that the presentation of the financial statement is different. Presentation of the financial statement is different. So under method two now, so I'm just trying to copy this so that we don't need to be wasting time to do that again. Under method two, the method of posting it is that there is nothing like other income. Look at the description. Method two, deduct the grant for the period from the related expense. So the financial statement will not have information relating to other income for year two. No, it's not going to have. So the only thing that we're going to be having now is what? The training expense. The training expense. And in our notes, okay, let me just do something like a note to the financial statement somewhere. Let me put it here for the method two. The notes, method two. Note for method two. Notes for method two. So in year, so let me have the year zero. Okay, there's nothing coming year 0, so let's just go to year 1. Year 1 and year 2. Year 2. The notes is what I'm having now. We are not passing journals again. The journals are the same. It's not the difference, the presentation that is different. The presentation that is different. So we just come here and say training expense. Training expense for year 1, we know it's 50,000 naira. 50,000. Let me pick it from here. This one's 50,000. And for year 2, training expense is how much? 25,000. 25,000. So government grant. Let me just call it grant. For method 2, government grant in year 1 is how much? That we recognize 20,000 naira. So we just say that equals, let me put it in brackets. We pick the 20,000 naira from where we put it in. And for year 2, government grant is how much? Government grant is 20, that we recognize is 10,000 for year 2. So pick it, put it there in bracket. And method 2 says net it off. Net it off, that is, just pick the net figure. The net figure that we are going to be recognizing as training expense in the statement of profit or loss. You see, this is what the note, the financial statement will look like. So when we just come to this place for method 2, the balance sheets of the methods are the same. Please, the balance sheet of the 2 methods are the same. You recognize all these liabilities and then like that. But the presentation in the profit or loss account is what is different. So the only thing we are going to be recognizing, which we are going to be presenting here, is the training expense. Training expense. Training expense. I want to pick I don't want to type it afresh. Training expense. And in year 0, since nothing has happened, no recognition. In year 1, we are going to be recognizing the net after the grant has been deducted. And how much is that? 30,000. And in year 2, we are going to be recognizing also the net after the grant has been deducted, which is 15,000. This is what we go to the financial statement, the presentation. Let me put them in bracket because they are expense, so that we know that they are expenses when we are interacting with this after the class. You see, that's the presentation. That's the presentation for these for the grant. That's the presentation. That's how it's going to be presented over the period that the grant is represented. For method 2, it's as simple as just net it off. Go to prepare a note. How much is the amount after expense incurred? How much grant relates to it? The net of it, since the expense is more than the grant, is what we'll take to financial statement as financial statement extract for that transaction. Do you have a question on this before we go to the second one? Please use the chat. You have a question. If there's no question, just say no question, or just say no, so that I type no in the box so that I can move on. Do you have a question? If there's no question, just type no in the box so that you can move on. Please, I need you to respond very fast. We don't want to waste time, so we can cover the topic we have for today. We have just about 1 hour left. Nobody's typing. Okay, please. Okay, no question. Okay. Who else has a question? Who else has a question? Juliet, any question? Mr. Sunkomi, Mr. David, any question? Any question? No question, right? Okay, I'll take it and see if there's no question, if nobody's writing anything down. So that is example 1 I've treated now on grants relating to income, and now it should be treated in the financial statement. So I put it in a special box of example 1, so that when you are studying it later, you see exactly what we have done. So that's it. That's it about that on the transactions, and you can see them yourself when you are interacting with the question. You can see them yourself. Let me just put all of this in the various boxes so that you don't mix them up when you are studying them. This is for the method 2. This is for the method 2 on grants relating to income, and then we have the journals that side. That's it. So let's move on. Is anybody saying anything again? Okay, everybody. So we go to the next one. This is what we just treated. So we come to grants related to assets. Grants related to assets. For grants related to assets, IAS 20 allows two methods of doing this as well. Method 1, deduct the grant from the cost of the related asset. The asset is included in the statement of financial position at cost minus the grant. Depreciate the net amount over the useful life of the asset. Method 2, treat the grant as deferred income and recognize it as income on a systematic basis over the life of the asset. You see, the two methods are similar. The two transactions, that is grants of asset and this, they are similar. One, you deduct from expense. This one says deduct from asset. And the two also say recognize deferred income. So that's it. The way they are treated are similar. So these two methods achieve the same effective result, of course, for method 1 and method 2, and that grant related to asset. So we are going to be looking at the example for that one too. A company receives a government grant of 400,000 naira towards the cost of an asset with a cost of 1 million naira. The asset has an estimated useful life of 10 years and no residual value. Required, how should the grant be accounted for in the financial statements? So we are going to be treating this for grants related to asset, and that's going to be our example 2. Grant related to asset, example 2. So let me put that one here. Example 2. Example 2. We're talking about grants related to asset here. Grants related to asset. Grants related to asset. Grant related to asset. So we'll be treating the methods. Okay, let's pass the journals as well. The first thing we do is to pass the journals. It will help us to know exactly what we have done. Remember, that was exactly what we did here. So let's do the journals, the double entry. Let's do double entry from from when the asset is actually purchased. We'll look at it now. Let's do double entry. So the question says, receive a grant towards an asset, the asset has a 10 years useful life. So this asset has a 10 years useful life. Under method 1, we said what? Deduct the grant from the cost related to the asset. So from the at inception, the journal at inception, that is, which is this one does not have year, 0 year, whatever. So let's just remove this year 0 of 18. We are just starting to journal, double entry at inception, the debit and credit for method 1, debit and credit for method 1. Okay, let me just say double entry for method 1, double entry method 1 here, method 1, the double entry for method 1. When the asset is actually acquired, what do? You debit the asset. With how much is going to be the net? So there's going to be what we call the note to this transaction. Okay, maybe I should do the note first. For method 1, let's do the note first. The notes. The notes for method 1. The asset is acquired. The asset is acquired for how much? Asset is how much? Asset is 1 million naira. Asset is 1 million naira. 1 million. So let me round it. I don't want too much zero, so let me round it to the nearest thousand. That we don't have too much zero. So asset is what? 1 million naira. So it's not 1,000 here. And the grant is how much? The grant, if you look at the question, asset is the grant is 400,000. The cost of the asset is 1 million naira. So asset is 1 million, grant is 400,000. Grant. So method 1 says what? We should deduct the grant from the cost of the asset. So the grant 400. Let me create more space there. So this is it. This is what we're supposed to do. That's what method 1 says. Deduct the grant from the cost of the asset, and so we have a net amount that we are going to be recognizing in respect of this asset. Now, this grant will not appear in the financial statement again, because the date we bought the asset, we try to net off the grant against the asset. So the only thing we are going to be dealing with is this 600,000 in respect of the asset. And so the double entry will do what? We debit the asset and credit maybe the payable. Debit asset with 600,000, and then if it is payable, let's say bank, we credit bank with 600,000. Why are we doing this? Because we have tried to reduce the value. So being the value of the asset, being the value of the asset, being the value of the asset at initial recognition, recognition. Being the value of the asset at initial recognition. So that is it. Being the value of the asset at initial recognition. And how much is that? We say 600,000 naira. 600,000 naira. That's double entry. So what we'll now be doing, the financial statement extract for method 1 is that what we need to do first is to also, so note 1, these are our first notes, talks about the value of the asset. Let's have note 2, which will be for depreciation. Note 2, depreciation. They have told us that the asset has how many useful life? 10 years useful life. Don't forget, 10 years useful life. So we're going to be depreciating just the 600,000 over 10 years of the life of that asset. That's what we're supposed to be doing now. We are depreciating this. So depreciation charges will now be what? The formula for depreciation will be what? 600,000 divided by how many years? 10. That's going to be the formula for depreciation. 600,000 divided by 10. Sorry, trying to put things right there. 600,000 divided by 10. So what is that going to be? Depreciation is going to be what? 600,000 equals 600,000 divided by 10, which is how much? 60,000 naira. That's our depreciation charge. That's going to be depreciation charge. That's depreciation charge in respect of this transaction. So when we are having our financial statement extract, the only element of this transaction that will be going to profit or loss account is the depreciation charge. The other will go to the balance sheet, which will be what? The value of the asset. So we are going to be having financial statement extract. Okay, statement of profit or loss extract. Statement of profit or loss extract, and this one will be why, because we are trying to do it for the 10 years that the asset will be used. So let me just start from here and say year 1, year 2, and then I can have that dragged to year 9, year 10. So why is this long? Because we are doing financial statement extract over the life of the asset. If they ask in the exam, this is what you're going to give them. Don't do anything less than this. If they say you should do financial statement extract, you do it over the life of the asset. So let me put the Naira sign there. The Naira sign, also dragged, we have it there. So the only transaction that comes under this grant related to asset, the only transaction that comes to the profit or loss is depreciation. For method 1. depreciation. That's going to be what every month. That's going to be how much every year? 60,000. So if I round this also to the nearest thousand, let me round this to the nearest thousand, sorry, so that we have a uniformity. Round it to the nearest thousand. We have uniformity. So what we're going to be having just what? 60,000. 60,000 minus 60. For each year, depreciation charges of 60,000. That's what we're going to be having for each year over the life of this asset. That's what will come to the statement of profit or loss. Only this will come to the statement of profit or loss in respect of this transaction under method 1. Don't forget, method 2 is different. So we're having now statement of financial position. Let me just use this place. Statement of financial position. Statement of financial position. Statement of financial position, and we are having this also drag for 10 years. 10 years. Statement of financial position for 10 years. So let me copy the year here so you can save time and put it here. 10 years. So what will be happening? Only the asset is also recognized here. The asset. Do we have the name of the asset? They give us receive government grant cost of an asset. You don't say asset. It can be whatever name they give you name in exam. Just put in it. So asset. Asset. Under non-current assets. Okay, maybe I should just do that first. Non-current assets. Let me put it here. Non-current asset first. Non-current asset. Non-current assets. So under non-current assets, we'll be having the name of the asset. Just say asset. Asset. And in year 1, we're going to be what? We have been netting the depreciation off against the cost. Don't forget, initially it is 600,000. So in year 1, it's going to be 600,000. 600,000 minus the depreciation for the year. Minus depreciation for the year, which is there. So we are going to be having 540 in year 1. 540 in year 1. And so we can then do this by saying, okay, come in. So each year like that, we'll be reducing it by let me see if I can drag this. Trying to see if the formula will work. Okay, that's it. So this is going to be the value of the asset each year. Okay, I should have put it here. Sorry, I positioned it. This way to be. That's it. That's what will happen in the financial statement. You just remove the. Don't forget the formula for calculating the, because it's net book value that comes to balance sheet. Cost minus accumulated depreciation. So as depreciation is increasing, and at the end of the year, which is year 10, the asset fizzles out. That is method 1 of accounting for government grants related to asset. Method 1. Method 1 is what we just treated now. This is how it will be treated. Deduct from the outset, at the beginning, deduct the grant from the value of the asset, and then depreciate the asset over the life of the asset. Don't forget how it said, deduct the grant from the cost related to the asset. The asset is included in the statement of financial position as cost minus grant. That's the cost of the asset. Then depreciate the net amount over the useful life of the asset. So we have done method 1 with this. Okay, we have done method 1. So we go quickly to do method 2. Method 2. Method 2. Method 2. Method 2. And for method 2, what does method 2 say? Method 2 say treat the grant as deferred income and recognize as income on a systematic basis over the life of the asset. These two methods achieve the same effective result. So what we are saying is we are going to be treating this. So the journal. So now we're going to be having here we have a journal. There was a note on calculating the value of the asset here. In method 2, there is not going to be this because we are not netting anything off. Asset will stand on its own. grant will stand on its own. And so the double entry is what we want to do now. Double entry under method 2. The double entry under method 2 is what? Then we have a debit, and then we have a credit for method 2. Okay, the double entry, let me put the Naira note there, rounded to the nearest 1,000. Rounded to the nearest 1,000. So debit asset with the total amount of the asset, which is how much? 1 million naira. Don't forget, I'm writing 1,000 because I've rounded it up to the nearest 1,000. And credit, bank or payable. That is payable if the money has not been paid, bank if the money has been paid, with the same word, 1 million naira. Credit the payable with 1 million naira. And being the value of the asset, being the recognition of the asset. So that's the description for that. And the second journal entry will be to recognize the grant differently. Here, we are not netting them against each other. So with debit bank, because the money for grant has come in, with how much grant was it? 400,000. So debit bank with 400,000, and credit deferred income. Credit deferred income. You see, with 400,000, recognizing it differently. And so that is initial journal that will be passed relating to this, being the recognition of government grant. Being the recognition of government grant. That's the description for that one. So after these initial journals have been passed, then we can have our financial statement. Don't forget that will be allocated. So let's have our financial statement extract over the life of these assets. So I'm going to be having it here. Financial statement of profit or loss extract. So this one says we are going to be recognizing what? Then, okay, there will be a note, and that note will be for depreciation. So let me just put it somewhere under method 2. The note, depreciation. For depreciation, so what we are going to be doing is what? For this interruption, I'm sorry for that. So for depreciation, we know what depreciation is, the value of the asset depreciated over its useful life. So the cost of the asset is how much? Asset at cost is how much? 1 million. So the useful life of the asset is 10 years. 10 years. 10 years. Therefore, depreciation will be how much per year? It will be the 10 years. That is the 1 million divided by 10. So annual depreciation is what? 100,000 naira. Annual depreciation is 100,000 naira. 100,000 naira. So let me just darken that and put it in its own box. That's the annual depreciation. So first, we are going to be recognizing what we call other income. Other income. Don't forget what the standard, the principle says, treat the grant as deferred income and recognize it as income on systematic basis. So when we are recognizing it, we classify it as what? As other income in the statement of profit or loss. So other income. Other income. We can put it in bracket, grant, so that we see it clearly. So in year 1, we recognize how much? The first year, we are going to split the grant, also the 400,000 over 10 years. So meaning that each year we are going to be recognizing how much? 40,000. Okay, maybe I should do notes. for grants too. This note for depreciation. So let me just do grant, the note for grant. Note for grant. So that we can see grant. The note for grant. The note for grant is here. Grant is how much? Grant is 400,000, 400. And the useful life of the grant is the same useful life of the asset. The lifespan also is what? 10 years. 10 years. Therefore, annual grant allocation will be the 400 divided by 10. 400 divided by 10. And so, annual grant allocation is what? 40,000 naira. So, other income, we recognize 40,000 each year for grant. Each year for grant. And that will go over the life of, that will go over the life of the asset. So 40,000 each year in respect of the grant, treated as what? As other income. Then we have depreciation. Depreciation. Annual depreciation, which we have computed, is how much? Is 10,000. So depreciation is 10,000. And that is going to be also for the period of the life of the asset for the 10 years. These are the informations that will affect statement of profit or loss relating to this second method. They are just telling us that they are treated differently. They are treated differently. Trying to justify this. Okay, just look at this. So this is how it will appear. That's it. Then we are going to be having statement of financial position extract. Statement of financial position extract for method 2. Statement of financial position extract. Let's put that one here. Statement of financial position extract for method 2. So we recognize the non-current asset. Non-current asset. And the asset will be there. The asset will be there. And the value of the asset for year 1 is going to be what? Cost minus the first year depreciation minus accumulated depreciation. Cost minus accumulated depreciation. So we are going to be having that as the cost is how much? 1 million naira. That is, this 1 million naira minus the accumulated depreciation. We have this as the value of the asset in year 1. So let me quickly put let me use a formula for this so that I can drag it. I'm trying to just put the formula there so that it doesn't take me time. Okay, sorry, you shouldn't have been. So okay, let me do it this way. Don't do it this way. So we're going to be deducting the following year. It's going to be this minus the depreciation for the following year, which is this. And then I can drag that over the life of the assets. Depreciation is how much? Sorry, what? Okay, yes, now. Depreciation is, I'm trying to check what I'm doing. Depreciation per year is 10,000. Is it 10,000? Did I do it right? 1 million over 10 years. It should have been 100,000. How did I? Okay, it's 100,000. Sorry, I was one that went to put 10,000 here. It should have been 100,000. I was supposed to pick this. I was surprised. It's 100,000. Depreciation will be 100,000 per year. Don't forget it's 1 million naira, and then the value of the asset is so each year the depreciation will be 100,000, and then we can then drag that over the life of the asset, and then you can see that's going to be the value of the asset that will appear in the financial statement under non-current asset. We're going to be having what we call current liability. This is the area where people used to get confused. Current liabilities, and we're going to be having deferred income. Deferred income. So we're having what? Non-current liability also. Non-current liabilities. And that also we're going to be having deferred income. Deferred income. Now, under current liability, deferred income that we are going to recognize in a year time is what will be recognized. Whereas under non-current liability, deferred income that is beyond 1 year is what recognized. So the deferred income under current asset, current liability for year 1 is going to be the total deferred income recognized, which is how much? 400,000 minus the deferred income recognized in year 1 minus these 40,000 recognized in year 1. Sorry, that's current. The current would be what? The one that we recognize in 1 year time, which is what? 40,000. 40,000. And the non-current will now be the total deferred income minus the deferred income recognized in year 1, that is the 400,000 minus the deferred income recognized in year 1. From year 1 to year 2, that is, we have taken year 1 out and we have taken as current liability the amount of deferred income that we recognize, and then the one that we recognize in a year time. So we are going to be having it like this. Look at it. Current liability 40,000, non-current liability 320,000. So that when we add this together, we are able to have 360,000 as the liability in respect of this as at the end of year 1. As at the end of year 1, we are having that as the liability as at the end of year 1. And the asset is what? 900,000. Do you see exactly what I have done? Current liability is a liability that we recognize in 1 year time, while the non-current liability will be the one that goes beyond 1 year. So in year 2 also, we will still be having the current liability for next year, and then like that, we'll be having it until year 9. Until year 9, when there will no longer be a current liability. By that time, we have had how many years? We have had 9 years. And this one will now be, we'll be deducting the current liability from each of this one. This will be the following year, non-current liability will be what? The non-current liability minus the current liability that we have recognized. And that will go on like that, we go on like that until when the non-current liability is also, it also fizzles out. You can see when the non-current liability comes to an end. This is how it's going to be. I hope you understand what I have done. This is how it's going to be. Non-current liability is a liability that goes beyond 1 year. Current liability is a liability that will be discharged in 1 year time. This is how we're going to present it. So at the end of year 9, we no longer have non-current liability. It's only current liability we have, and that current liability will be used, will be recognized as an income in year 10. So that at the end of year 10, no current liability, no non-current liability. The asset also has ended in year 10, and just like that. This is going to be what the financial statement extract will look like over the life of these assets under method 2. I hope you understand what we have done. Statement of profit or loss will look like it under method 2, and statement of financial position will look like this under method 2. That is going to be the financial statement extract for these transactions over the life of the asset. Do you understand, or do you have a question? If you have a question, use the chat box. Sir, the percentage should be 100. Okay, thank you. I didn't see this chat. I later also discovered that. Sorry, I didn't check your chat. I was thinking it will beep when the chat comes in. Just opening the chat now to see if you are. So if there's no response from anyone, I assume there is no question, so I can go on. I can go on with what we have to do in class because of our time. So I'm going to give this as practice question. I want you to do this. So let me send it to the chat box, hoping that you will see it and then work on it using the methods, the two methods. That's to prove that we know it. So please practice. Usually I follow the packs because I use ICANN packs to study. So I encourage that you also go with ICANN pack. You can't miss your way if you go with ICANN pack. You can't miss your way if you go with ICANN pack. That's the only thing I studied. That's the only knowledge I have in accounting, and it never disappointed me. Even sometimes you can be so lucky that we use an example, you bring out an example that they put in their notes, in their pack, as exam question, as you should say, as exam question. So we need to get familiar with that. So I hope you can see the practice question. I want you to work on that after the class and test your knowledge on what we have done based on these depreciation grants relating to asset method 2. So method 2 extends to this place. Let me just open it like that. Then this double entry, this notes to the financial statement, notes to the financial statement, and that's double entry. And the other one, method 1 also extends to this place. I want to put it in its own box so that in case you are studying it, you also understand the extent to which you should go. So let me just take that, put it in this box like that. Our example 2 ends there. Example 2 ends there. So let's continue for the few minutes we have left and look at now grant received, receivable subject to condition already met. This is double entry. When you are expecting that the money should be released, don't forget the ones we did earlier is that you have collected the money. That's why we debit bank and credit deferred income. Don't forget, I hope you remember the journal here. They have released the money, and the first thing we are doing is with debit bank, this journal recognizing the grant. Debit bank, credit deferred income. So the explanation is that when you are fulfill the condition, you are expecting the money. Say a government grant may be awarded in order to provide immediate financial support rather than an incentive to undertake specific expenditure. So they may just want to give financial support or as compensation for expenses already incurred in previous year. In this case, the double entry will be debit the receivable or cash if the money has been received, credit profit or loss, which is what you do. If you have already fulfilled the obligation, it will no longer be a deferred income that time. It will be what? An income recognized for the period because you have fulfilled the obligation. Why are we recognizing deferred income? The obligations are still not yet fulfilled. An income you have not earned, but you have received or you have recognized. So you debit the relevant, if it is a receivable or cash, and you credit deferred income. And then over the years, you recognize the deferred income as income. It will convert from liability to income. But when you have already fulfilled the obligation, the second leg goes to profit account. Repayment of grants. The government grants may become repayable. In this case, it is accounted for as a change in accounting estimate. What we mean by that, we have treated the standard IS 8 in class. If you have watched the video, change in accounting estimate is applied prospectively. Prospectively means from the date the change has taken effect. Those of us just joining, you need to refresh your mind on that standard. Please, the video is on this platform. just avail yourself the opportunity of watching all the videos of the previous classes so you can see what we have done. One of the benefits of this online class is that the classroom is open anytime of the day you are free. Even if you don't get a thing in class, you can watch the video over and over again. And then if you have a question, even when the class is not in session, you can always put the question in the box. I will see it and I will respond as appropriate. So please, so change in accounting estimate is applied prospectively. Prospectively means from the date the change takes effect. If it is change in accounting policy, it is applied retrospectively. Retrospectively means that you will go back to the year that you started the transaction and apply the change as though the new change occurred at that date. So a repayment of grant related to income is first applied against any unamortized deferred credit recognized in respect of the grant, with any difference recognized immediately to the profit or loss. We are saying grant related to income, or if maybe the conditions that government gave you, you no longer could fulfill it. And so government says, the money we gave you, please pay us back now. Pay us our money back now. Or the liability we waived before, previously that we waived for you before, you must pay it now because there's a breach of contract. You did not fulfill your part of the bargain. How do you treat it? You treat it as a change in accounting estimate prospectively, meaning that the income you have recognized in the previous years, you are not going to be going back to those previous years and removing the income. No, you recognize all the payment in the current period, except the ones that you have not yet recognized, which is deferred income. A repayment of grants related to an asset is accounted for as follows. If the grant has been recognized as a reduction in the cost of the asset, which is method 1, and the repayment increases, the repayment increases the carrying amount. That is, the carrying amount of the asset will increase. If the grant has been recognized as deferred income, the repayment reduces the deferred income balance. In either case, the extra depreciation that would have been recognized in profit or loss today, in the absence of the grant, is recognized immediately in profit or loss account. That is, if you have used the method 1, we'll be seeing an example now to treat this. If it is method 1 you use for the grant related to assets, see how we treat it. If it is method 2 you use, in either case, he said the extra depreciation would have been recognized, will now be recognized in profit or loss immediately. That's it. That is those depreciation that we have not been recognizing because we reduced the value of the asset. We now say that circumstances giving rise to the payment of grant related to an asset might be an indication of impairment of the asset. So we now see we treat as if the asset is impaired in the case of the rule under IAS 36. That's a standard we are still going to study in class. IAS 36, impairment of asset. So the example, repayment of grant related to an asset deducted from the cost of asset. That's the example we are having now. Repayment of grant related to an asset deducted from the asset. So please, before we treat this example, let me explain the repayment of grant related to income. Since we don't have an example for that, don't forget that grant related to income, when we did it initially, what we did under the first method is that you recognize the income separately and recognize the expenses separately. So let's assume, let me quickly treat this one before we treat that asset. Let's assume that this grant that was given relating to income is now to be repaid at the end of year 1. The cost for the grant at the end of year 1. Because throughout year 1, the 12 months of the training, you didn't do the training. Yes, you have collected the money for the training in December the previous year. But you didn't do the training. And you have gone in year 1 to go and do what? To go and, okay, let me say it is called for at the end of year 2. Because year 1, so let's just go to year 2 to make it further complicated. But at the end of year 2, 18 months have passed. You did not do the training. Government has said, oh, you think you are smart. Okay, give us our money back. How do we treat that? So quickly, let's do that. And let's do that example as our example 3. Example 3. Example 3. Example 3. So repayment of government grant related to income. Repayment. I hope that my battery is able to see us through. It's telling me I have 30 minutes remaining. because I have an issue with electricity, and I hope the 30 minutes should be enough because we just have 20 minutes to the end of the class. So I hope the remaining does not lie. So repayment of grants relating to income. So we'll use this example. Since we don't have an example for that, let's reverse the one we did earlier. So when it's related to income at the end of year 2, so let's assume that these grants will be repaid at the end of year 2. So what's going to be the double entry? Double entry. Let's put double entry here. Double entry. Double entry. The double entry at the end of year 2 when the grant is repaid. Double entry year 2. Okay, let me just take it down a little. Year 2. Year 2. Year 2. It's only the double entry I'll be showing. So what is going to be happening if at the end of year 2 is when we are to they call back for this money we have recognized previously? What is going to be happening at the end of year 2? So we have debit and then we have credit. Then I put the Naira sign there. Sorry, I think I copied the Naira sign. I put the Naira sign there. So when it is in year 1, we have recognized 20,000. But because it's a change in accounting estimate, we cannot take back the financial statement of year 1 and go and be removing the 20,000. No. But at the end of year 2, we are going to be recognizing the payment of this grant back to government and writing it off to the statement of profit or loss as if all the income was recognized in that year 2. So we are going to be debiting statement of profit or loss, debit statement. Okay, let me just debit profit or loss, profit or loss with the amount paid back to government, which is how much? 30,000, the total amount we collected from them. And then we credit our bank, which is where the money is going out, 30,000. You see? That's it. So this one will be treated as an expense in year 2, as though we incurred the expenses. So, we have recognized 20,000 year 1 as income. Year 2, we can't go back to year 1 and adjust it. We just recognize this. So our financial statement will now show what this one will show as an expense during the period. And the 10,000 we're trying to recognize, we will not recognize it again because it is still the current year account we are preparing. The 10,000 we should recognize for year 2 will no longer be recognized. Once we debit our profit or loss, it's as if we have incurred an expense during the period, and then we credit our bank with this amount. Or, okay, let me split it. Let's do debit profit or loss with 20,000, since we have not recognized the other one, and debit deferred income with 10,000. Deferred income. Yes, that's exactly what you should have. Sorry, deferred income. 10,000 was still in deferred income at year 2 as opening balance. Yes, this is how it should be. Sorry for the first thing I told you. This is how it should be. Debit deferred income. Don't forget, as at the beginning of year 2, which is the end of year 1, we had 10,000 naira as current liability as opening balance for year 2. Don't forget, these are closing balances in balance sheet. We have closing balances there. So closing balance in year 1 is the opening balance for year 2. So current liability was still having a deferred income of 10,000 that should have been recognized as income in year 2. So this income in year 2 will not be recognized. That's what we are saying. Rather, we are going to be recognizing an expense of 20,000. The previous 20,000 that we recognize as income will now come here as an expense in year 2, and then the other 10,000 that we had in deferred income will be reversed, and the journal will be, so this will just be the repayment of government grant. Bring the repayment of government grant, being the repayment of government grant. That's the journal, that's explanation. That's journal explanation. I hope you understand that. We don't have an example for this. That's why I quickly use that example to let us see what the journal entry will be like. So let's now treat the example of that one relating to asset, because that one is the one that actually seems a little bit complicated. So example 4, let me call that example 4. Example 4. So repayment of grant, repayment of grant relating to assets. Relating to assets, and then what's the condition attached? Relating to asset deducted from the cost of the asset. Deducted from the cost of the asset. Relating to asset deducted from the cost of the asset. Sorry, let me check this battery. Okay, 22 minutes just now. 22 minutes. Okay. I would have gone to put on gen. I don't want to interrupt the class. They took the light while the class was on. I'm supposed to go and put on gen now, but we have a few minutes left. If the battery will not carry us, we will conclude this example in the next class. Because if I say I should leave, we can put on gen, I will just have 14 minutes remaining for the class. I don't want to delay the class. So now the first thing is that the question says a company received a grant of 400,000 towards the cost of an asset with a cost of 1 million. The asset has an estimated useful life of 10 years and no residual value. The company deducted the grant from the cost of the asset. 3 years after the asset was purchased, the company discovered an irregularity in the original application of the grant. As a result of this, the company was required to repay the grant to the government. How should this repayment be accounted for? It happened in year 3. So first we do the double entry. Okay, no, let's first do the note to the account. What has happened so far on this asset? Notes. Let's just have a note first. Let's look at what has happened so far on this asset. What happened was that at the initial stage, the asset was carried at a net value after the grant had been deducted. This was what happened at cost. At cost, the asset was 1 million naira. 1 million. Let me round this to the nearest thousand. I wish this battery will carry us through. I don't want to put it on because of time. And then the grant, just like you remember what we did. I think this was what we did in example 2. Just in example 2, we treated this. Okay, let me just copy the note so that I don't have to repeat it. This was what happened initially. Now, the asset was depreciated, and the depreciation note too. I think we did depreciation note for this. Depreciation note that we did there. Okay, I'm coming. The depreciation note is there. So the depreciation note too. This was what we did. I want us to see exactly what has happened over the life of the asset. The depreciation note, we are saying that we have 60,000 naira depreciation. Yes, every year. Since it is 600,000 recognized for the asset. So what we're now saying is we have had 3 years depreciation. So note 3, depreciation till date. Note 3, depreciation till date. That's accumulated. Let me just say accumulated depreciation at year 3. At year 3. How much is the accumulated depreciation at year 3? That is what 60,000 times 3 is the accumulated depreciation at year 3 times 3. So 180,000 is the accumulated depreciation as at year 3. What's the value of the asset as at year 3? Asset carrying amount at year 3. The carrying amount is how much? Let me put it here. Let me copy this one. The carrying amount is what? The cost. After that is the net of the cost, which is how much? The 600,000 we recognize here, less accumulated depreciation. Which is how much? 180,000. 180. That's it. So what's going to be the net book value? Net book value will be, so as at the date we discovered this irregularity, this asset was having a net book value of 420. Now we can't go back to those 3 years You see, we can't go back to those 3 years and then be removing the depreciation and accumulated depreciation we have done. We are going to apply this change prospectively. So the journal will be, let's now do the double entry here. Double entry. I'm trying to be checking. I don't want this thing to go off on its own. Say 16 minutes. And I know it's a lie. It will not take me to 16 minutes. Don't worry if we didn't finish in this class because of these few minutes remaining. Because I don't want the system to go off on me. I want to be sure we save the video. So the double entry, let me just do this journal. The journal. So double entry at year 3, at year 3. The double entry is, now we are going to be debiting the asset. The asset carries a debit of 420. But how much are we paying back to government and how much is outstanding? We are going to be recognizing this grant as a whole. So the grants that we have allocated to date, we are paying it back to government. So the first double entry is to debit our debits. Okay, we credit bank when the money goes on, and we are going to be debiting the remainder part of the asset that we have not recognized. That's how much debit the asset first. Yes, debit asset. With how much? The 400,000 that we took out of it previously. We are taking it back to the asset. It must increase. It has 420. The 400,000 we want on credit bank because we are paying the money back. Don't forget that the asset was carried at a net value after the grant has been deducted. That's the first journal. Being the reversal, being the repayment of grant. Being the repayment of grant. You see, that's the description for that. Now, the other notes that we are going to be at. So the next one will be what? We are going to be going to debit. So how much depreciation should we have recognized? Should the asset carry its value? We can use this method 2 to determine it. This method 2 we did here when the asset was standing alone. The depreciation should have been 300,000 for the 3 years if we did not consider the grant. And so, but because we consider the grant here, the depreciation was what? 180,000. So what should have happened is that the second journal will do what? We debit profit or loss. Profit or loss. With the difference in the depreciation. 300,000 minus 180, it's 120,000. That is equals 300,000, which should have been the depreciation. 300,000 minus 180, which we have recognized depreciation. So P&L will carry this, and then we are going to be crediting. Let me see, asset. We credit the asset. We credit the asset with 120,000. I hope you understand this journal. We credit the asset there with 120,000. So being the under depreciation for 3 years. Being the under depreciation for 3 years. That's it. That is the depreciation that we did not charge, that we should have charged, that but we were unable to charge because of the asset. So in the note, the asset note, let me check how many minutes I have left. Okay, let me just do the note to the asset now. Note to the asset. Note to the asset. The note to the asset will now be what? As at this year, I want to copy the Naira note. As at this year 3, the asset has a carrying amount of how much? Carrying amount of how much, which we calculated here. The carrying amount is what? 420. So the carrying amount of 420. The asset has a carrying amount of 420,000. Now we have been able to add back the grant. We are going to add grant previously deducted. Which is what we did by passing this journal. And how much is that? Let me see. How much the grant previously deducted? 400,000. Then deduct the under depreciation, deduct under depreciation, which is what we did there by crediting the asset, and that's how much? 120,000. 120,000. Then the current value of the asset in the financial statement will now be what? So what I will be doing in the next class, I will stop after this one. What I will do in the next class is to do the financial statement extract of what the financial statement will now look like after this. So the value of the asset will now be 700,000, which would have been its value at the grant not being considered. Okay, sorry, let me stop this now. I want to save this record. I'm sorry, this thing, I don't want it to shut